So basically how this works, this is the most simple way I can explain this, is you have capital, you guys got to put it somewhere. So you just stick it into your policy, call it a bank, because essentially we're doing banking type strategy. And when it comes to leveraging your cash and you need to utilize it, you don't actually borrow your money. You actually don't take your money out of the policy. Your money is the collateral for the loan. And so you go to the insurance general fund, they give you they give you a loan on your cash value, and then you buy an asset with it. And then while that loan is outstanding, they essentially have a lien on your cash value, and they don't care when you pay it back. There's no payback requirements. You have to pay it back in 5 years or 10 years. You could never pay it back if you wanted to, although that would kind of defeat the purpose of the strategy. But you don't have to, because they know one thing's guaranteed in life: we're all going to die someday. So if we pass away and there's a loan outstanding, they keep it, and the difference, whatever's left over of the policy, so you have the death benefit plus the cash value, that's going to go to your beneficiary tax-free whenever you pass away. So and then
I want to unpack that for just a minute.
Okay.
So here's a real life. My story is that we needed to take out money to do some renovations on our house.
Mm-hmm.
We took a loan against my husband and my life insurance policy. Mm-hmm. That was probably 10 years ago.
Mm-hmm.
It is still paying me every month the interest rate that we took it out at, and I can choose to put that money back in, or it can go for the life of my through my life, and
mm-hmm.
it will take out the money that I paid, mm-hmm. that was paid to me, and I never have to pay it back. I think that is so everybody understands this. It's a loan. You can choose to pay it back. You don't have to. You have, mm-hmm. access to this cash.
Yep. And I'll cover the specific how the loan function works, because it's nothing like traditional financing, like you would go to the bank. It's just the reason it's a loan, just like you're refinancing, you pull equity out of a property, that's a loan. That's what allows it to be tax-free. But some of these loans can be as low as 0%, depending on how it's set up. But anyway, so now you pay that money back. Your asset, you refinanced it, cash flow, whatever the situation is. Now there's no more loans, so there's no more, your cash value is not collateralized, so there's no lien. Now you have an asset that can help, to potentially fund this. And also too, you can have multiple of these policies too. You're not limited to like one. I know I personally have two. So people have multiple policies, and you can open up different accounts. Like if you have a bucket we create and you max that out, you're like, oh, I can put more in. You can add additional policies to make bigger buckets.